Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, September 16th, 2025. It's 11:07 a.m. Eastern Time. I'm starting the video, so we're a little more than an hour and a half into the trading day, and just wanted to go over again some of the things I'm watching as we head into the potentially big FOMC meeting tomorrow. I say potentially. We know most likely what we're going to get rate cut wise, quarter points, still baked in the cake pretty much. But anything goes, and it's an interesting time in history with all the political pressure from Trump on trying to have the Fed yield to his power, and we'll see where that goes. So again, it's about not only what they say, of course, what they do. We could probably get the quarter point. Anything else would be the market would have a huge move in either direction. So I don't think that's going to happen. Of course, then what they say. And then most important is how the market reacts. Now, again, I'll cover that tomorrow. After the meeting, I'll do a post-market wrap-up after Powell's Dog and Pony Show. But I want to do this video right now and kind of continue to impress some of the things I'm watching right now, key levels in the market and key sectors and other developments to watch for. We've got some kind of cracking today. Now, I'm going to say this, I always say it, but it bears repeating. You need to take breakouts and breakdowns that happen right in front of Fed with a grain of salt. But on the flip side, that also doesn't mean that they can't stick. What I mean by that is, as I often say, you get increased whipsaws, false sell signals, false buy signals. The days leading up, especially in that week, those 2-3 days leading up to a Fed meeting, they always meet on a Tuesday and Wednesday, conclude at 2 p.m. on a Wednesday, release their statement, whether they're going to cut rates, hold them tight, raise, and then, of course, little brief comments, and then Powell will come on and do his press conference after. All right, so this is SPY. This is that 60-minute bullish falling wedge, and we're cracking ever so slightly below it, nothing impulsive. It is not impossible, but it would be unusual to see a huge move in the market right before a Fed meeting, especially when there's not a lot of, sometimes you have that near 50-50 chance whether they're going to do a cut or not cut or do 25 or 50 basis points. This one's pretty solid, so the market is probably going to just trade on its own, technicals, if you will, until then. So I'm going to put a little shelf of support right there below SPY. And I can also, very easy, if I want to take this trend line and play it and move it and put it under that wick of that candle right there, in which case we're right on the trend line now. But again, I believe this is the better fit. I always say trend line drawing is an art, not a science. My preference is to include the largest number of wicks and bodies. That's or I should say, the shadows, the skinny part. It's a wick when it's up top. It's a shadow, a tail when it's down below, and then the body's the fat part. So I try to include the most number of shadows and or bodies, so therefore you'll exclude some of the wicks that drop on an uptrend line. Those shadows that come down below being called wicks. There. So yeah, it's a breakdown. You might have to squint to see it. And then you have this just in the last few days. You can see a little trading range here. But the way it works is if that goes about 659.28, it's going to clearly have taken out the trend line and also taken out this cluster of candles right here on SPY. Now, I'm going to get to the more important thing, why I think these breakdowns are likely. I know I'm on the very, very small minority. And I'm not talking about even the most ardent bull must expect some kind of a little pullback correction after we've been just kind of drifting higher the last few days. QQQ, as somebody pointed out, had like 8 or 9 consecutive updates. SPY didn't do that. SPY is one of the biggest differences between the S&P 500 and the NASDAQ 100, other than the fact the S&P is much more diversified, many more stocks, 500 instead of 100, but also much more importantly, more sectors, 11 sectors, more balance between those sectors, more defensive sectors, and what the S&P has that the NASDAQ is lacking is a very significant weighting of financial stocks. I'm going to spend a lot of time in this video talking about that. And so that's it. So you can call it a sell signal. You can call it what you want. And you can, again, take it with a grain of salt. What I told you yesterday, my preference based on the charts are the charts. I'll take a sell signal. I just won't go heavy right in front of a Fed meeting. But I wanted to point that out. When I look at the S&P 500, this is a chart I gave you or went over in the video yesterday. Sometimes they fixed it. Sometimes this program will give you a long false. It's always a wick on the, or I'm sorry, yeah, wick on the, I'm sorry, a tail, long end of the candle when they roll the futures, and we just rolled recently into the Decembers, but now it's fixed. So we're right on that trend line you can see there, and this is again the S&P 500 futures. Big negative divergence. If I'm a betting man, which by nature I am, based on what I do for a living, then I'm going to say this will break down. Despite, again, I'm in a very small minority. Everyone's rah rallying. Fed's going to cut rates. It's going to be very good for the economy. Remember what I've been saying for a while now. Careful what you wish for. The Fed's cutting rates because the job market has shown clear evidence of turning up. The unemployment rate turning up, job market turning down. And again, as I've pointed out many times, historically, there is no go there, bounce up a little. Once the clear inflection point, the clear turn from falling unemployment in the trend to rising, it's always been historically, again, pretty much a V bottom with acceleration starting after that turns in. It kind of starts a little slow and then starts to build momentum. So we'll see. This time could be different. COVID was a whole, unique, never before seen in history where the world economy shut down. And so, everything's a little wonky and has been since then. So, all right, guys, that's it. So there's your S&P. So we're right on the trend line now and on the futures. And this is the NASDAQ 100. Let's see if there we go. Good. Went away. And we're right on the trend line now. So no sell signals on the futures. As I often say, especially in a resilient trend like this, where the market, just doesn't want to pull back or wants to have, it's triggering false breakdowns, you want to, or I want to see both the futures and the ETFs go. In other words, QQQ and SPY. So here's QQQ right on the line, like I just showed you on the NASDAQ futures. No surprise, 60-minute chart. Remember, we stopped this one out, so I'm just going to leave those notes there for now because I still have these targets, which I still think have a good chance of being hit if we play out, if we get a breakdown here. And again, this would be now your first target there. There's a little gap they're going to target. These are new short-term micro, that's a micro support level. That's a better support level right there. And we're right on it. But if I want to play the game like I often do, come down, you see these little skinny shadows down there. I'm going to pull it. And yeah, you can say you're right on the line if you want to do it that way. And no reason not to. So, all right, guys, that's it for the markets. And again, if you get a breakdown, as I often say, I like to say the redder the better. In other words, you get a little limp down through there, especially only one of these four, QQQ, SPY, ES, or NQ, then you might want to, especially in this market, wait for the rest. And then once the Fed's out of the meeting, once the meeting's out of the way and Powell's press conference, if you find QQQ and SPY, down here well below the wedges, then it's safe to say that breakdown is in play. There's no guarantees. We had a sell signal here, back here. We shorted that, or no, right there. We hit our first target. We bounced as expected. This has been a little higher bounce. And again, that's all. I'm going to trade off the charts and let you know where we're at there. IWM, I should hit on the smallies mainly because the KRE, I've given you the fifth third short, and I told you yesterday, and I'm going to get to it today. If you don't want to short an individual bank, you can have diversity, safety, and numbers by shorting KRE. We're going to get to that in just a second. That's the regional bank sector ETF. But what I do have on IWM is a breakdown. We have two 60-minute candle, three so far below it, and that's this trend line right here. So there's a sell signal on IWM. I like IWM. I had some RTY increase today. Again, nothing crazy till the Fed's out of the way. Why did I increase? I'm about to get to that in 1 second for you here. So let's just dive into it. Let's just go into Fifth Third, which I gave you in yesterday's video, and I stated that I was covering it both as, you know, what's going on in the markets, plus a trade idea. I highlighted I started out highlighting we come full circle. We had a divergent high there, then a sell signal, trendline break, followed by a drop of 30% in that stock. And we have an identical technical posture, divergent high. This time we had a little bit different. We had a breakdown of the trend line, back testing it from below. And then finally, if you followed me for a while, you know, I like to see that rejection. I say the problem with shorting a back test is when you short a back test of an uptrend line, well, an uptrend line has a positive slope, meaning the rise over run is positive, meaning it goes up every single day, comes in at a higher and higher price. So you can find yourself shorting or holding onto that short, well, you're still back testing. So I like to see that impulsive rejection, a big red candle, and that's what we got right there. So that was the end of the back test. Then we went down and we went a little sideways for a little bit. We hit this trend line here that I gave you, the minor uptrend line, aka forming a price channel right there. And then that was a sell signal yesterday. I said we'd get if you want to take it as a short on a break of that. Now, I also gave you, which I still maintain, S1, which is also what I call a BOD, or benefit of the doubt support level. Anytime I get a nice, well-defined support level that comes in very close proximity to another support level above it that broke, well, you want to give it the benefit of the doubt. Now, for me, the Fed meeting, and enough, again, I'm doing this long-winded video to show you that it's not just Fifth Third. If it was only Fifth Third, I wouldn't have shorted RTY. Why did I short RTY? Most of these regional banks are in the small cap index, Russell 2000. And so you're going to get, and they have a high correlation. Birds of a feather flock together in that sector. So when KRE is down 1-2%, you usually see the Russell 2000, i.e. IWM or RTY, down about that much as well. So it's just it's a proxy trade, if you will, guys. And consider that too, you have overlap. I started out in the video earlier showing you IWM broke down, but I'm also, you know, highlighting, as I did yesterday, KRE and the regional banks as a short. But again, I'm going to say it one last time, Fed happens tomorrow, and if they come out and, you know, they say or do something that it could ignite the regional banking sector, and we could go up. So no reason, unless you're just an absolute gambler, to build or take a very heavy position of anything, really anything that's rate sensitive or may move from the Fed. What I mean by that, there's some obscure commodities out there that have no correlation with the stock market, and you can maintain those positions, you know, into a Fed meeting. But things that are indexed heavily, or again have that correlation in the market, that's up to you. You know, the key to successful trading is money management, proper money management. And, you know, you can't eliminate all risks in the market, but you can certainly mitigate a lot of risks, such as going heavy, long or short into a stock when they report earnings. That's a great example. Or again, going too heavy positioned into a Fed meeting. All right, that's it. But it's not much more to add. The next sell signal comes, well, I think I already said it yesterday. Set alert below S1, 44.25, and then gave you the targets on that one. And this is KRE. I'm going to go here. And KRE, as I showed you, same thing. That was a divergent high right there. I'm going to borrow this writing, duplicate it, as I covered in yesterday's video. That was a divergent high. And we had a nice clean, this is our primary uptrend line off the lows right there, off that big divergent low. And, you know, this is last bear market or correction, whatever you want to call it, in KRE. Came back up, back tested once, rejected, back tested two, rejected. And now similar, but a little bit different, but similar to Fifth Third, you have this longer uptrend line, which forms more of a wedge than a channel. And then you have this very minor uptrend line, which was recently broken out. So you can see right there, I had a resistance level at 64.45, which was taken out today. Again, the reason I'm doing this video, updating this, even though I just covered these guys yesterday. It was the recent support shelf. You can see, look how many candles. This is a daily chart, by the way, guys. One, after the breakout, this was your breakout candle above that level. One, there's a little tiny red one there. 2, 3, 4, 5, 6, 7, 8, 9, 10 back testing that level. I didn't include the ones above it, all the ones. So very good support level taken out today. So that's a sell signal. I would be shorting it more aggressively if it didn't happen right in front of a Fed meeting. But again, I like to get a little starter in. That way, if these things just rock the other way, I'm not going to get burned. However, if it does this just a quick swoon down, then I don't have to chase, because I don't like chasing entries on stocks that aren't objective. A lot of times if something just gaps down too low, and if it's something I've been waiting for weeks or months to trigger a buy or sell signal, if it gaps up too much away from it or down too low on a short, I'll just let it go or wait for a kickback, a rally or the next objective entry. But so when I have a starter position, it's easier for me to add because I already have a gain or a profit on the starter position. So that makes it a little easier pill to swallow if I think it's worth chasing. And believe me, I will sometimes chase. If I think there's enough downside or upside on a position that started to move, I will. I've learned over the years that which ones, hey, go ahead, to break out. You might not get that pullback that you're looking for to get in. And so again, I'm just kind of sharing with you some of my strategies here. All right, so look, next support, well, the uptrend line first, right? And then I have a level here at 61.68. That's defined by this support shelf right there, which broke. We regained it here. It acted as support again. And so that's would be kind of the first target zone, if you will. Then the 200-day moving averages. But again, I look at, I kind of, well, I always do. I trade multiple time frames. And I look at the big picture. And, these are when you want to be covering shorts and going long on divergent lows, especially to support. And these are when you want to start shorting for trends. This is trend trading. We can swing down, swing trading, try to swing down that first run, cover on support. That's why I list multiple price targets. You can swing a lot of these moves in and out, even game the counter trend bounces. And the bigger trend says, based on this is when the regionals topped here. Why is the stock market at all-time highs, but yet the regional banks peaked back? And so many other sectors, guys. It's not just that. So that's it. Let me show you a few others of the individual holdings. I do this because, as I say again, an index or a sector is simply a sum of its parts. So when I see, especially in a resilient market right now, where everyone's foaming at the mouth bullish, no chance of recession in any time on the horizon, Fed's going to cut rates, market's going to go to new highs, blah, blah, blah. I mean, I read the headlines. I know that, and I look at sentiment surveys. I look at put-to-call ratios. I look at all that stuff. So I know that's not everybody's opinion, but it is the collective, opinion of the masses right now. So with that being said, when you have that kind of frothiness, bullish, hold on to your, buy the dips, hold on to the stocks, you've got to have, I always use the analogy of a criminal defendant in court. In a criminal case, you have to be proved innocent beyond, guilty beyond the shadow of a doubt. So the prosecution needs to come and bring their A game. They got to have everything they have to build a strong case to get a conviction. When you are shorting in not just a bull trend, but a resilient bull trend, you've got to have a lot of evidence. So that's why I do these videos. Hope you understand. And so, as I was saying a second ago, an index or a sector, in this case, the sector being the regional banking sector, is a sum of its parts. What are its parts? Well, I have, when I queue in a sector ETF, like I just did KRE, to your right, you can see the holdings. I sort those by market cap to get the biggest banks, up top. They typically have the highest weighting in the sector and the most importance. And so we're going to go over that. You can see my chart. You can see all my annotations. That was a divergent high. That was a divergent low. There was a breakout, nice rally. These are double-digit rallies, counter-trend rallies. Divergent low, rally, divergent high, drop, breakdown right there of the trend line. And now we've come full circle. This pattern right here, again, I think I covered it in yesterday's video. The only difference is we were right on the trend line. We had that sell signal today. That's why I'm firing off video and being repetitive on what I just covered yesterday, just to make sure you're aware that this thing's broken down. Now, yeah, could the Fed foil that? Sure. Or can they build on it? Absolutely. So we'll see. And the day that I stop, I try to guess what's going to happen. I'm not a purely mechanical trader. I will, and you guys know this, I often pass on breakouts that seem a little suspect or I'm not comfortable with. And quite often I'll jump in front of a breakout, get long on a stock before it's even showed the evidence of a breakout or a reversal, because I have such a high degree of confidence that that's coming. Usually in those cases, I'll take a starter position first, then add to a full position once that you have a pretty decent evidence, some type of bullish reversal pattern, breakout of a bullish pattern or something else. All right, so that's it. I just wanted to say that Truist, one of the biggest regional banks, I'm going to give you a level right here, has broken down. So yesterday we were just flirting with that trend line. We were just a hair below it, but at that BOD, benefit of the doubt, 44.85 support. So I'll just rifle through this, and you can look at the charts. You can see the annotation. They're not all annotated with DH, but you can see the common theme here. And again, so if I go through here and I go through the top 10 components, and of the top 10, they all have very similar bearish technical postures, right? You got to understand the differentiation between a bullish trend, which we're in. They've been in a bull trend since April. They've been in they peaked back here, but since April, it's a clearly bullish trend. Nobody can argue that. However, it's a bearish technical posture, at least the way I read charts, negative divergence. And then these nice, clean, well-defined uptrend lines. That's an important thing too. The better defined they are, the higher probability is that once they break, the breakdown will stick. Why? Because more eyes see it. If I have to force some trend line and I have maybe 2 points, and I take a position on a break below or above that trend line, well, I might be the only one looking at it. So the better defined it is, the more reactions, the more likely it is a lot more traders, longs who are bullish, have their stops somewhat below it, and flexible traders like myself that will go long or short will jump in on that breakdown. And then of course you have the two, you can see here, look at this red line that I'm highlighting. That's the 200-day moving average. When you're above it, you buy pullbacks to it, right? And so you got to take that out next. And when you're below it, what do? Once you take it out, like you did there, you short rallies back to it. All right, so that's it. So those are the levels to watch. And again, this is, I'll go a little quicker on the rest of them here. You can set price alerts on those. In this case too, you can see that the 200 exponential, the red line, is the last of the two that come in. The blue line here is your 200 simple. So I don't care much about that. You always want to give it the last of the two, or which one it's been reacting more on lately as well. And that's both in both cases there. That's the 200 exponential moving average. And then you do have some price support just below it. They're going to come in. If they take that out, it wouldn't surprise me. In fact, I'd probably expect an intraday break of them initially, and then buyers come in and step in and buy that reaction low, get a little bounce. But once those levels are clearly taken out, whether or not we get a reaction first, then it opens the door to a much bigger drop. And if all this is for nothing and the regionals do this afterwards, well, what I look for, are they going to take out these divergences by bringing out and taking out those previous highs in the indicators? If so, it just makes a hard case to short, or to get short, or be short, stay short. That's it. So I'll adjust accordingly. I gave you a stop loss, adjusted stop on the 5th third trade. All these are similar. I mean, the first thing you don't want to see, and again, I'll wait till the Fed's out of the way. If the vast majority or all of these banks that I'm covering today that have broken down, let's say they build on these breakdowns into tomorrow, but then they recover them after, meaning move back above the trend lines, well, that's the first sign you might be in trouble right there, that the breakdowns may have been whipsaws. So you could stop out at that point if you want, especially on a solid daily close. Not just one, but collectively, if the majority of these recover these trend lines after the Fed. There's Huntington starting to crack. The day is very young. So as I like to say, the redder the better. Right now it's a big red candle. And again, we took out these recent trading ranges on a lot of these regionals. We'll see how the day closes. Again, anything is possible, but I don't expect fireworks. I'll welcome it. But again, it's not going to really, if we have a big down day between today and tomorrow, you're going to just come down to the next support levels. So I'm comfortable right now with the starter position on the regional banks and the smallies that I have room to add to or subtract from. Maybe just close out depending on what the Fed does. All right, guys, this is, I mean, these charts, I'm sorry, I had to do this video. This is beautiful charts. I had alerts going off this morning like crazy. Look at that. That's, yeah, I don't have to squint to see it did that one break down. This is Regions, another bank I used to work for, their brokerage program. I've worked for half of these, Fifth Third, Regions, some others that are no longer around anymore on the brokerage channel for these, what they're called super regional banks. And yeah, that's a nice breakdown, guys. So Citizens, I mean, come on, look at this trend line. And so Fed or no Fed tomorrow, it's in my name, and resilient trend or not, I can't sit on my hands. I can't not take these breakdowns. I would infinitely rather have them prove to be whipsaws and take a small loss on these positions than miss out on such a beautiful breakdown. There it is. So they're all these. I'm just clicking. These are the ones I went through some of these in yesterday's video. You can just see so many breakdowns today, and they're all coming up on support. So, and the Fed meeting tomorrow, so you'll probably see some dip buyers. Pavlov's dogs. You know, a resilient trend like this is a powerful thing. When that bell rings, the dogs salivate. You know, classical conditioning 101, especially if you've ever taken any psych courses in college or wherever. And that's it. So the bell rings, meaning you get a pullback. The dip buyers will step in and buy. But when things start to change is when you have very little, if any, reaction, or even if you get a bounce, if it's just a minor bounce, then you go down through there. And again, if you take out this, this is just, what is this? SSB, South State Bank. Look at this. You have a beautiful, clean uptrend line off the lows. The 200-day moving averages, which they step in and buy once you take them back. When you lose them, you lost them right there. You bought them here, bounced. Tried hit them again, but couldn't bounce. No buyers there. There's a case where you just went down right through resistance. And what does that tell you? Hey guys, you're in a bear market. Short rallies back to the 200s, and you would have had that nice leg down. Rallied up. Hit the 200 perfectly, reversed. Hit it again perfectly, reversed. Finally, right here, what happened here? We took back the 200, the red line right there, 200 exponential. And then we're in a bull trend. That, now we also have higher lows and higher highs, right? And so, boom. And so you can make that case. And I know, we have a couple of folks, at least one very bullish on the site. Buy every dip. Market's just going to go up forever, or at least for the foreseeable future. I get that. Take these same levels that I'm looking and expecting and waiting for to position to get more aggressively short in the sector, or to even cover, depending what happens. We get there, I may just, and you know me, I'm an active trader. What I buy today, I could sell by the close today, or what I short today, I could, close that out. But if you believe this uptrend has a lot more to go, I'm giving you the key levels to watch. And so you can take it glass half full or glass half empty. If you're a glass half full guy or gal, you buy. This is nice support right here. And this is the biggest drop the stock's had in months. It's comparable almost to that one right there. You can buy here. That's about 99. Or if a break below there is going to bring you to even better support. The uptrend line plus right there, that red line. Here, I'll brighten it up a little so everybody can see it in the video. The all-powerful, for this sector at least, 200-day exponential moving average. So you can buy there. If you think these stocks are going to break down, you don't want to buy there because you may just go right on through it. So as a short seller or somebody bearish on this stock or this sector, if it approaches there, you can sit tight on your current position. You can lower stops to protect profits if you want, and or wait to add on a solid breakdown below the 200s. And even if you're only trading SSB, you would want to watch the other stocks I'm covering. Again, that's why I do these videos, to show you that there's one that's coming up on trendline support, WAL. I don't have them all marked up. There's a lot of stocks in this sector. And as you can see, as I'm drawing this, some of these are coming up on support right now. And we're going to roll into the next thing. All right, let's move on. You got, I don't need to oversell that. I think I made pretty clear what the charts look like, what I'm watching. This is the financial sector ETF, XLF. This has the big banks in there as well. JP Morgan, it has the credit card issuers. Visa, we have an active trade going on this one. From back here, we hit my first target. What did we do on this one? They're kind of separate or new trades, depending on how you look at it, because I stated on August 6th at the lows, that day we peaked bottom, in one of the comment sections that I was going to cover. It's time to cover all shorts, go full long, and we hit a lot of targets. T3 was hit there. So it was initial short, I guess, was over here, somewhere off that divergent high. And yeah, we hit my first, second, and third targets, or maybe I just added this one back recently. Let me see. I can look at it here. T5 821, 6.9. So I created that on 6.9. Okay, this is, guys, because I cover so many stocks. 6.9. Okay, yeah. So right here. Yep. So that's when I would have given it to you. So we shorted it right there. We came down. We hit my first, second, third targets. We hit it again. And again, these are just like the previous targets on the stock market, my long-term targets. I still maintain those targets. We've made, as expected, would be a marginal move, but still divergent high. And so again, the way this works is on Visa, and this is also one of my things to watch list, because it's very, very much a tell on the economy. It's all about, remember, these job numbers are convoluted right now. You've got Trump trying to, firing the head of the agency responsible for the data because he didn't like the revisions, and trying to control the Fed right now. So the market can't trust the data coming out, but what you can trust are charts of companies like Visa, MasterCard, and Amex. Trying to what's going on in Creditville. There's MasterCard coming up on that yellow uptrend line, and then AXP is American Express. And so no breakdown on AXP yet, but if it does, you can see these are all targets down here. We need to take out that trend line right there. And it looks, to me, it's going to happen. Look at this divergence right there. And then the other ones I watch are the big payroll companies, paychecks. Again, why? See the employment numbers that you get coming out with their staffing shortages, with cutbacks in the federal government. They use a lot of imputed data. You get these huge revisions. Some of the revisions we had a couple weeks ago were massive. So it's hard to trust the numbers. What you can trust are stock prices, because although insider trading by definition is illegal, it happens all day, every day. It's prevalent, and there's even legal insider trading where insiders will sell their shares, if it's stated ahead of time. And so those in the know, when you watch companies like Paychex and ADP, and when they turn, you don't have to wait for the government data to come out. This is the best tell, in my opinion, on the jobs market. Now, Paychex is coming down to support, but look at this. We put in a divergent high. It was all telegraphed in the charts. This was covered. That was a divergent high there, negative divergence. Beautiful little uptrend line, breakdown, and look what happened. When it broke down, it didn't just limp around for a while. It was a straight full throttle down to that first support level bounce, took that out, in one fell swoop, gap down, took out the 200-day moving averages where they buy it during uptrends, buy. A couple intraday or daily tried attempts to get back above there, but kept running into that resistance, rejected. Now this stock is clearly below its 200-day moving averages. That's Paychex. ADP is even bigger. If you're listening to my voice and you work a job at a corporate, pretty much anything but a mom and pops where you're cutting your own checks, one of these two are probably issuing your paycheck or processing it. And here's ADP. Again, divergent high. It's just like the stock market, divergent high. Wasn't the top, but it was a top. Nice correction. The divergence got bigger, got a bigger correction, and the divergence got even bigger, and we'll probably have one of these. It's usually the third time's a charm. But where are we at now? Let's turn off all the lines. You can see ADP has a history of just punching down through briefly the 200s in a bull trend. But once it clearly takes them out, you're in a bear trend. Now, remember, we've been in a big bull market for a long time, especially since COVID, job market, record lows. So you got to really go back a long time to see, and you can do that here. You can do it on this chart here. This is a weekly chart where the 40-week simple and exponential moving averages are the same as the 200-day. And let me turn off the other stuff. I don't know if you can see it on the chart, but that's it. Those are those lines, the red and the blue. And that doesn't look like much, but when you took them out there, I'm going to put my crosshairs down to where ADP bottom. That was a 25% drop. You can call it a bear market. You can call it whatever you want. Right there, we took them out here. You can see that there was a drop. And again, this is a weekly chart. So that's a multi-week drop. You still had 12% to profit from a short or to sidestep to get out of your long if you were an ADP long then. And that was when the big Q4 drop of 2018 hit. And then right here, you took them out and there was a 40% drop. So we've had a couple brief, couple moves down below, but again, they've all been multi-week, multi-month drops, 15% there, and that's it. So I'm just kind of painting the big picture on the things I'm watching, which are really financials. That BIZD, I'll wrap up there. This was the one that I started highlighting about a month ago for you. Tell you, I'm watching a lot of things. I always watch a lot of things, but this is one that I think has a potential to be one of the areas where the next shoe drops. And I talked about this recently. I talked about, these are the business development companies, aka private credit. And so when I started covering it, told you a break at this level would be bearish. That was support. We've now hit that. Give you targets. I might have added one or two more since yesterday's video. One more. And I noted down here, any drop below this T4. These are the targets if you did take this short or if you wanted to short it. Maybe you get a bounce back to this 1574 level. Maybe not. Either way, these are all the price targets on it. And this is where all hell will break loose because it'll show you there's problems in there. Remember, these private credit loans, it's just like private equity. It's very obscure, and you can have drastic pricing resets. They can only, when something dips in value, they can sit there and tell you it's 80, 90, 100 cents on the dollar on their books for as long as they want. But once something sells and the market starts to reset, the longer they do that and fictionally inflate the price, the worse it's going to be. So you can see these things kind of unwind fast, and they usually do, but it takes something to break somewhere for that to happen. Like I said, yesterday's video, this is kind of a red flag right now, or a yellow flag, not a red flag. Fed's going to cut tomorrow. ARC, that's one of the big components here. Look at that drop. Something's going on there. But it's at really nice support now. So again, if you're bullish on this sector or this particular stock, that's good support. This is one of the top, showing me that one of the top holdings in that one. ODBC, Blue Owl Capital, breaking support today. BXSL. I'm just curious, why is this happening? The Fed's about to cut rates. Why isn't that spurring? Why isn't it helping the regionals right now? And again, maybe it's just a little profit taken before. Maybe they already ran up leading up to the expectation of the cut, and that's just natural profit taking. I think it looks like something else is going on. But if they continue lower, all I can tell you, this is an incremental thing, not a binary thing. With every tick lower, every new support level on each of these companies it's taken out increases the odds you're going to get more downside to the next level there. All right, this one, FSK, KKR Capital, just took out. We do have a reaction low I need to add right here. See where I'm putting the line? There was a reaction low there, which we're coming up on now. Other than that, you could see, the last time the stock traded down below there is when the world came crashing to a virtual standstill. Financial markets imploded, needed to be bailed out by federal stimulus and monetary and fiscal stimulus. And again, ask yourself, with the stock market at all-time highs, why is why are these private credit companies, why are they trading down so, especially this sudden rush for the exit. So all right, that's it, guys. I don't want to beat a dead horse, but these are the things I'm watching. And yeah, just wanted to mention to you, GDX, an alert. GDX has cracked that trend line, and as I told you, I've been watching. Newmont is right on the line now, so you really need to see Newmont, the big dog in the sector, take that level out. So keep an eye on that. That's one I'm going to wait for a little more evidence. I don't want to jump in just yet on a GDX short, but no, there's quite a few of them that are cracking. And once Newmont cracks, then you'll probably get a nice, swift, potentially very swift rush from a very crowded exit in the mining stocks. So just going to draw on the lines here for you. All right, I'm going to wrap it up there. And just to reiterate, if the financial sector, which again should be benefiting from a rate cut, and maybe that's all priced in and this is just natural profit taken, but again, I'll go off the charts. If you see the financials break down, remember in the S&P 500, the financials are your second largest sector. I updated this recently, earlier this month, at 14%. So they still dwarf the weighting that the tech sector has, but it is the second largest sector. And again, you lack that in the NASDAQ. So you could see if the financials continue to roll over and start to get some downside, if there's some problems there, you could see the S&P 500 fall nearly as much as the NASDAQ 100. I'll usually trade NQ, whether I'm bullish or bearish on the stock market, long or short, because it just moves up and down more in a multiple of whatever the S&P is doing. But when you have cracks in the financial system, that's when you can get those days where the S&P is falling as much, sometimes even more. It's unusual, but I've seen it. Again, it takes the financials usually getting clubbed on the head to do that. So, all right, guys, those are things to watch. And again, Fed meetings tomorrow, so I'll probably not be posting a lot between now and then, and still trading a diversified portfolio, long, short, natural gas and things like that don't tend to aren't really affected by the Fed. So since that pullback, this one's starting its next leg up, just needs to pop that previous high and open the door to any or all these targets. So that's another one where, again, if you're looking for something to trade, and you don't want to be in equity markets, this is still one of my top picks. All right, I'll wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.